Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Anton Mattli. Anton is the CEO at Peak Financing, where he brings his decades of experience in commercial and investment banking, private equity, and commercial real estate. And in just a minute, we're going to speak with Anton about commercial debt financing, the changes, terms, and the challenges we're currently facing in this market. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and you can find us at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest. Anton, welcome to CRE PN Radio.
Hi, Darren. Thanks for having me.
I'm looking forward to our talk today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure, would love to. As you can hear, even though I'm based in Dallas-Fort Worth, Texas, I've been living here now for roughly 15 years. That accent is not from East Texas nor West Texas. I was born in Switzerland right after school. When I graduated, I joined an investment bank, then joined them for a training program in New York. And I worked in New York, in Tokyo, and Hong Kong for a number of years in various positions in investment and corporate banking. And after that, I left banking directly and have helped high net worth individuals, family offices with their direct investments. And out of that, we also saw the need to help them on the debt financing side. And that was the reason why we founded Peak Financing. And our role is a commercial real estate debt broker. So we are not a direct lender. We essentially help our investors to find the most appropriate debt for a particular project and market and them as a sponsor. So there are thousands of lenders out there, and among them a few hundred or might be appropriate, and we help to identify the ones that are actually making sense for a particular project.
Got it. Well, your experience is certainly kind of wide-ranging and commercial finance, as far as like with the what I'm trying to say, Wall Street, what do you call those banks? The big commercial banks.
Commercial investment banks.
Investment banks. I don't know why I was having like a complete brain fade there. So when you're working at that level, I mean, and also the family offices and stuff, that's pretty high level financing, is it not? I mean, that's not somebody trying to buy a little building kind of thing. That's more. Can you talk a little bit about your experience there with the investment banking, and then also
Sure, definitely. Yes. The transactions tend to be much more complex because the sponsors or the borrowers have more complicated structures. The transactions themselves, sometimes they're really easy, even if it's a $100, $200, $300 million building. If the transaction is straightforward, it's not that more difficult to do than a $5 million building. The challenge very often really comes into play when there are complicated borrower structures, as well as when you have complicated deal structures, whether it's real estate, particularly in some markets like New York City, you have air rights that have to be considered, you have land leases and so on. So that's where a lot of these difficulties come into play. But other than that, it's just a larger deal. but I wouldn't say that it's that much of a difference compared to even a $5 or a $10 million acquisition when it comes down to it. I was also involved in a lot of cross-border transactions. So there you have another element that obviously comes into play, which are the associated risks with cross-border investing, as well as all the tax issues that are related to that. So luckily for most US-based investors, the tax situation is pretty straightforward. And as you know, and as many of our listeners know, the tax structure and what is available from a tax perspective in the US is probably one of the most attractive reasons why you want to invest in commercial real estate.
Yeah. No, I want to ask you a little bit. You mentioned the structure of like the participants as well as the deal. Is the financing is on those larger deals? Is it often that you'll have one lender, or will you have like layers of financing that different people participate at different points, or not different people, but different lenders?
Yes, that's a very good question. It varies a lot. In most instances, a lender, particularly for large deals, is not lending from its own balance sheet. There are two main options that are really being used on an ongoing basis. Either it's, as we call it, syndicating it or participating it with other lenders that are similar lenders like the bank. So it's essentially spreading the risk among multiple participants, and that's kind of a negotiated structure of that deal. The other one that has become extremely common and is a core piece, particularly in commercial real estate, is securitizing these loans after they were originated. So they are essentially, you have a lender that originates the loan, let's say 50 million or whatever it might be, and for that, usually it's its own balance sheet that is being used, but very often it's also has access to, as we call it, warehouse loans from another lender that provides the funding for these for that initial loan. And then the lender starts packaging that loan together with other loans that are being originated over the course of, let's say, 3 or 6 months, and packages that and so-called securitizes it, and then these loans are essentially sold as a bond into the market where investors can buy a piece of that loan. It's not just that loan that is being bought, but it's essentially a pool of loans that are part of that bond that is being issued.
Got it. That's fascinating, and I can't remember what's the I was just thinking the technology that's kind of the cornerstone for like Bitcoin and all these digital currencies is, and I can't remember what the name of that is. I don't know why I'm just having kind of complete brain fade here today, but for those securitizing, when they have those large deals, and they're selling, tranches or however they're doing that, is that basically to institutions that they do that, or is there other opportunities for accredited investors to get in on those type?
It depends what type of security is being created. Sometimes it's sold just to institutions. Sometimes it's to accredited investors, but very often it's also sold to the public marketplace, where anyone really can acquire these securities. I would say probably the best known ones that are out there are all the Fannie and Freddie backed mortgage-backed securities, which we obviously have become aware of those during the Great Recession with with all the housing market issues and the financing that was was a big element of it. But that is not just on the residential side; it's also on the commercial multifamily side. So when we talk about multifamily properties, a big chunk of that, more than half, is financed through Freddie Mac or Fannie Mae, but through their multifamily programs. And these loans are packaged. They are ultimately put into various pools that then are being sold as securities. And anyone who has a brokerage account essentially has access directly or indirectly through their brokerage account to some of these investments, right? Then you also have so-called CMBS loans, which are not agency-backed, but are more privately securitized and private-backed. And there it's the same thing. A lot of these commercial CMBS loans, as it's being called, they are being put together into pools that are then securitized pools that are sold into the marketplace. And not all of them are publicly traded, but some of them are, right? So it's only possible that the private individual, in addition to the institutional investors, have access to some of these securities.
Yeah, that's fascinating when you kind of look at it from a 30,000-foot view of just all of the different ways that financing is structured and put together, and just the huge volume of financing that's done, and how much of the world economy is tied to commercial lending. I mean, it's kind of boggles the mind when you really look at how it's all kind of tied together like that. So that's awesome. So now you mentioned that you're working with like family offices and others. Is there a particular size of deal that you typically do, or is there a sweet spot for you guys right now?
Yeah, I would say our sweet spot is typically a loan size of 2 million up to maybe 50 to 75 million. We can do any loan size really, but what we typically see is once you get above the 75 or $100 million mark, for traditional assets at least, it's mostly institutional investors, and they have their in-house full-time staff that is able to do what we are doing, right? Finding the most appropriate lending solutions. Whereas as we call it, the middle market, which is up to the 50, maybe 75 million, depending on how one defines it, typically middle market owners do not have that capability in-house. Technically, they could hire them, but it's very costly to do. When you do, let's say, a dozen transactions of half a dozen transactions per year, so then it's easier to just hire us on a transaction by transaction basis. We have been involved in larger size of deals when it's a little bit more of a complicated structure, but I would say the majority is in that $2 million to $50 million dollar range. And our clients, a lot of them, again, when we talk about middle market, that also includes a lot of syndicators. And that's particularly in the multifamily space, right? In retail buildings, office buildings, industrial buildings, there tend to be more private investors, institutional investors, and less so syndicators. But when you look at the multifamily space in that 5 million to 50, 75 million size range, you have a massive amount of syndicators that are active in that space. And I would say there only our client base contains quite a number of those groups.
Yeah, that's interesting. Do you have any kind of theories as to why the syndication's not as, um, I guess, popular or common outside of the multifamily?
I think it's really has been driven by all the coaching that has been offered over the last primarily 10 years. It was available already for 20 years, but it's only has started out around 10 years ago when when a lot of these coaching firms started to focus very specifically on multifamily investing, and that was just mushrooming, particularly over the last 5 years. So the amount of investors in that space that are newcomers is well beyond of what you see in any other commercial real estate asset class, right? And I think that's the reason why you have a lot of these so-called boot camps where hundreds of people attend, then they are joining a training uh, uh, program. And as part of that training program, obviously, they are being trained how to buy multifamily property and syndicate deals. And with that, so many groups are offering that now. The amount of sponsors, as we call them, deal sponsors, has just mushroomed over the last particularly 5 years.
So let me ask on that, because as the market changes, or I guess the participants, uh, and it sounds like kind of probably a level of experience has probably changed quite a bit from, say, 20 years ago. I'm assuming that more of the sponsors were maybe a little bit more experienced. Does that sound plausible, or?
Yes, I would say that is certainly a concern of ours, and I would say that's also a concern of a lot of lenders that are out there. That because of all the newcomers, that the experience level is not nearly as strong as it was with multifamily owners. Let's say 10 years ago, 15 or 20 years ago. Uh, Now, some lenders, as a result, have implemented stricter requirements, specifically when it comes to experience, to kind of counter that element of someone just showing up at the boot camp, getting to training, and then being able to buy a multifamily property within 6 months of hearing about it for the first time. So particularly Fannie and Freddie have implemented stricter rules, so it's not that easy to do it on your own. So typically you have to bring in someone who has that experience, and that's only will reduce the risk. Having said that, the problem is a lot of these individuals that have that experience, they also have that experience only doing the best of the times in multifamily. So I think there is still a little bit of a concern there, that there are a lot of, as we call it, the fair weather investors in multifamily that have seen only an upward trajectory over the last 10 years, but have never seen really any retraction to speak of. Right? Obviously, we have had a very brief one maybe 2 years ago, and now last year we had it with COVID-19, a very brief situation that was a little bit scary. But after a few months, everything returned to a boom environment, and it actually COVID-19, with all the money that has been put into it, with the liquidity that came into the market, actually has further pushed the prices up to levels we have never seen before. So that is only a concern, that a significant amount of investors in, particularly in the syndication space, they have never seen any downturn yet, right? And so with that, I think some of them are just a little bit too bullish, and are not necessarily recognizing the down risk, but only look for the upside.
Yeah, no, it's interesting. I've been doing insurance for almost 30 years now, and I've got clients that uh, have lost a lot and also made a lot, and then I have clients that have uh, they always are finding ways to make money in whatever market, but I think the what's amazing to me is how quickly the '08 is forgotten, and for especially for people that are new in it. And also I think the people that got in post '08, I mean, like you said, all they've seen is up. They've never had any kind of a down cycle, and they're still thinking you just buy low, fix it up, sell high, or they don't have any sense of just what normal is, or what a normal market is, kind of thing. And I don't know. I'm curious. What are your thoughts, or what are you when you work with different lenders and the investors you're working with? What are their thoughts? What are your thoughts on just where we are, and what's coming?
Yeah, I would say the majority agrees that we are in uncharted territory, and very few really know or pretend to know where we are going, right? And I think that's probably the scariest part, that we know things are extremely strange, right? We have massive amount of liquidity that has been put into the market in pre-COVID, and now with COVID-19, it has mushroomed even more so, and we have record low interest rates, uh, and we still have liquidity that is being tossed at us. So we are in an environment that we have never seen before, and everyone really has to question, well, how is this all going to end? And I don't think that anyone has an answer to this, right? From my perspective, I feel at some point we will have an inflationary element that will really kick in. We already see it, but the market somehow doesn't believe in it and still buys into the Fed's view that it's only transitory inflation. I personally am not so sure that that is really the case. Uh, uh, but ultimately, no one really knows, right? So my main fear really is if it's inflation, when you're a real estate investor, that's generally not a bad thing to be in real estate, right? Because your rents likely can go up, your NOI will follow the inflation path. Uh, so you should still be reasonably protected. My main concern really is not just inflation but stagflation, right? And obviously no one knows whether it's going to happen, but if the economy really gets into a difficult situation, we have increasing prices, and at the same time we have an economy that is contracting, then we are in a really tough spot, and I'm not so sure how that all will turn out, right? So that's my fear. I would say a lot of investors have that fear in the back of their mind. But obviously, as an investor, you have two choices, right? So you sit on cash and you know that's likely the value goes down, or you invest and you trust that your investment is still a better choice than just sitting on cash.
Yeah, no, it is a kind of a balancing act. That you mentioned the stagflation. I think I would tend to, again, I'm not an economist, but I can just tell you that it seems like everything I'm buying is costing more than what it did. Um, and I'm not measuring by the consumer price index, where they only measure like things like wash machines and refrigerators, and but just real life day-to-day consumption, whether that be fuel, uh, your food, just the day-to-day things that you're experiencing, plus the labor shortage, where, and I say the labor shortage. I've talked with numerous people, and I think that a lot of the industries are doing just fine, but some of more of your retail, especially your hospitality, uh, employment issues are really challenging. But you follow that through whether it's a COVID effect or whatever it is, but there's some sort of a lag in whether the supply chain or people or whatever. And I haven't really followed it as closely as I'd like to, but I know that it just exists across almost everything. Whether it be, what you could normally expect to be able to go to the store or a supplier and buy. Now you're being told it'd be 3 months or weeks or whatever to get. And there's a cost increase based on just the availability of the products and that. So, I mean, there's definitely some inflation underfoot. I'm curious, you mentioned stagflation. And I'd like to just revisit that for a second, because I think to me, that's something that's, with the Federal Reserve and all of the powers and levers they have, it would seem to me that would be at a point when they lose control of the train. Does that not make sense? I mean, or if they kept interest rates so low that they can't go any lower to where they can't stimulate the economy, is that kind of what that would?
Yes, that's really where ultimately we are, right? And that's what my main concern is, other than just issuing bonds and buying them back and putting more liquidity into the market. They do not have, when it comes to interest rates, they do not have any more power left there, right? And that is really my main concern.
So, do you have any thoughts about negative rates as far as another gear to shift into to try and make things keep going? Or
I don't know. Obviously, we have seen it in Europe. We have seen it in Japan. I'm not so sure that is going to happen in the US. I think we just are just hovering around virtually zero short-term interest rate environment for quite some time. Obviously, the question is, are they finally recognizing that inflation is there? The problem is, I think they recognize that inflation is there, but they cannot afford to raise rates, because then it really would impact the economy.
Stall,
right?
Stall.
And it would stall it, right? So they are really stuck, in my view, right?
Yeah. Are you? And I'm not exactly entirely familiar with, other than just the references I've read about back in the 70s when the Fed actually increased interest rates to get to break the inflation kind of thing, and the pain that caused. Do you have any sense? I mean, I just, again, as just somebody that's trying to make my world work, and a lot of times that may be with a rate finance or something like that on a property or whatnot. But I guess my question is if we have inflation and we have stagflation, if they were to increase the interest rates, I'm assuming that would automatically be a price reduction, because if your interest, or excuse me, your real estate is priced based on debt cover ratios and NOIs and how that whole equation works. If all of a sudden your interest rate goes up and you're at a point where you have to refinance or sell the property, if you're a syndicator and you've got to get the money back to your investors, I mean, there is kind of a natural cycle in a lot of these. I mean, all the deals have a cycle to them, right? I mean, when you get in, you know about when you're going to get out. And if you're unfortunate to be in the deal when all of the financing terms change and you've got to sell, it seems to me that's where all those people have been waiting for that to happen and have cash are, make big money again based on patience.
Yes, yeah, it's a very good point, right? Right now, the view is the Fed will keep the interest rates low, and they are not going to rock that boat, right? And I tend to agree with that, right? I've obviously on the short end side, they have some flexibility to increase the rates without the market really being too negatively impacted. When it comes to the 10-year Treasury, I foresee that they are much more concerned about that, and that they will implement some form of a yield control there. So if the market feels that the inflation is really kicking off and the 10-year Treasury yield gets well above the 2% mark, I believe that they will implement some form of a program to just buy up whatever is necessary to keep the interest rate at maybe somewhere between 2 and 2.5%, right? So I think from that perspective, I'm not that concerned that interest rates on the borrowing end would increase that drastically, strictly from what the Fed is planning to do. My main concern is, and that's really how the market looks at the risk itself of lending to the marketplace is, and we have seen that in 2008 and 2009, even though the interest rates came down, the actual borrowing cost went up, right? Because the spreads increased. So lenders were not really just saying, okay, now we have a lower index to fund from, so we are passing on the spread. They increased the spread, so your borrowing cost still went up on particular assets, even though the federal interest rates came down. And so I think that is more of my concern for owners, that they may think, well, everyone talks about keeping interest rates low, so our risk of having suddenly higher borrowing costs is not really that high. I think one forgets there that there are still private market participants that decide what risk premium they really want to have in order to finance a property. And that also applies to buyers of real estate, right? So right now, everyone says, well, with interest rates low, the cap rates will stay low. Cap rates are not going to go up. As we have seen in 2008 and 2009, even though the interest rates came down, cap rates still moved up because everyone was scared. All the buyer pool that was available before disappeared. And that still, in my view, is going to happen at some point. And I think that's really the risk that I think a lot of the newcomers are just not recognizing, that despite record low interest rates at the federal, short-term rates and treasury level, that doesn't mean that the borrowing costs will really stay at similar low levels, and that cap rates will also stay that low.
Yeah. No, it is interesting, and I appreciate you sharing or kind of reminding us that there is a market element. It's not just the federal interest rates that determine the market. Because I think that the part of what the '08 collapse was just a fundamental lack of underwriting at the borrower level, and how the market was basically being hijacked by all of the kind of the fake or the ratings and the lenders or the lending criteria and the fog and mirror, the 125% loan to value and no credit checks and all that. I mean, I don't see. I feel like the one thing that's good about the U.S. Market is that if there is something that seems like it's systemic and it gets corrected, I feel like that element has been, that's not going to happen again. But I think that this is the reminder is that, while we may have corrected the one thing, like you've said, throughout this conversation, is we don't know what the future is because we've not been there. We've not been here yet. And so I think that's the concern, is what is it? What's it going to be that's going to, create the correction when it happens, kind of thing. And I guess stay tuned and we'll all find out together, kind of thing, right?
Yeah, absolutely.
So
Yeah.
are you seeing that, you mentioned experience as being kind of, underwritten more as a premium. Are you seeing lenders requiring more equity? Are they still lending to the same valuations, the same percentages, or are lenders, is the underwriting tightening up as far as the percentage loan to value that lenders are willing to go?
Yeah. So the loan to value and the debt service coverage ratios or debt deals, depending on the program, really have not tightened at all. But what we see is, because most deals, or today's only in the multifamily space, tend to be not value constrained, but are debt service coverage constrained, right? Because people buy these properties at very low cap rates, going in cap rates, and the higher you pay for, the higher the prices you pay for a property. Obviously, your if you want, let's say 75 or 80% leverage, technically that would be available. But if you apply a minimum 1.25, let's say, debt service coverage ratio, you're not able to get to that 75 or 80. Sometimes we see it, particularly on the multifamily side, for agency loans in major markets, you may end up at 55, 60, 65%, right? So that is really where the constraint lies. So lenders haven't, I would say the positive element there is that lenders have not moved away from that minimum debt service coverage to allow a higher leverage, right? And I would say that is certainly a positive element there when it comes to at least the traditional lenders, right? Where I'm more concerned is on the bridge side. Bridge lenders virtually disappeared last March in 2020, when COVID-19 essentially shut the whole country down within the course of just 2 weeks. And as a result, bridge lenders, most of them disappeared overnight, and it took several months until that the bridge space recovered and restarted. Now, look forwarding to today, a little bit more than a year later, we have more bridge lenders than ever before. There is so much liquidity that goes into that bridge space. So that's where I'm more concerned, where a lot of bridge lenders are willing to lend very aggressively. And it's good for us, obviously, to help borrowers and buyers to get these bridge loans and get higher leverage. But I would say there's only are some aspects of bridge loans, if the market turns or when the market turns, that these loans will have a hard time to actually get into a permanent loan in 2 years to 3 years, as it's being projected, at least on paper, right? And that is particularly the case. A bridge loan has its space, right? If it's a true value add property where you have to do rehab, where you can increase rents and so on, a bridge loan is justified. What is happening, though, is, as I mentioned before, a lot of these agency loans now may come in at 60, 65% LTV. So in order to overcome that, a lot of buyers now are taking out a bridge loan so that they can get to the 75, sometimes even 80% leverage. But it's all driven by their projections. So if any of their projections are not turning out, or if the borrowing environment changes over the next 2 or 3 years, they will not be able to get out of that bridge loan, right? And that is where I think certainly that space in the lending area certainly, in my view, is definitely overheating.
Yeah, that makes sense because that's probably the riskiest end of the lending spectrum, isn't it? Where you've got kind of a short term and a higher interest rate, and very sensitive to a change in the economy, or if you're not able to complete your deal, or you all of a sudden have vacancies instead of, you can't meet your projections. I mean, that'd be
Yes,
the
that's right.
bottom line.
Yeah.
Yeah.
So I would say from a cost perspective, from an interest rate perspective, at least for larger loans for 10 million and up, they are extremely aggressive on the pricing side. So you can get all-in rates. They are mostly floating rate based, but you can get all-in rates in around 3%, 3.2%, 3.3%. So it's extremely aggressively priced. So the pricing side is not really an issue. It's more of what you have said. Can they perform as per their projections, right? Can they raise the rents as projected? And then also equally important is, can they refinance in 2 or 3 years, right?
Right.
Or the cap rates where they are still are today. That is an absolute must, and or the refinancing rates at the similar where they are today.
Right. No, it is. It's a fun thing if you buy something and the rates compress and you win on the exit, but it's a whole nother thing if you buy on some compressed rates and all of a sudden the market slows down and the value goes down, and but again, that if your model, I guess cap rates to me are more of like an entry exit point thing. I mean, they definitely deal with financing, but as far as the operations and your NOI, that's more of a function of what rents you can get and how you can control your expenses. And if you can keep that number, going forward, I would think you at least have an opportunity to finance out of your debt, refinance your debt if you had the 125 cover ratio. At least that would give you some sort of a backstop. Am I thinking that right, or do you see
Yes,
it differently?
you're right. As long as the interest rates do not move up by the
Right.
time you refinance, and the cap rates are not moving up when you refinance, right? So, and that really has happened, again, going back, you mentioned 2008, 2009, where a lot of people were caught there. On the multifamily side, it was not just on the single family side, on the commercial side, the same thing happened, including multifamily. And that's what I really remind our clients whenever we talk about the potential risk there, is that interest rates may go up, right? So that obviously will have an impact on your debt service coverage. But even if you can achieve that, if the cap rates go up, your loan to value also may be more of a challenge, right? Because the higher the cap rate, the lower the valuation is, right? So if an appraiser today assumes that in 3 years from now, it's a cap rate at 5%, and then the true cap rate might be 6% in 2.5, 3 years from now, keeping the same NOI in place as they projected will result in a lower valuation. So even if the debt service coverage might be achievable, maybe the valuation at that point could be an issue too.
Yeah. So you might not be able to get any cash out, but hopefully you would hopefully you didn't go too long on an interest only loan, and you're knocking out some of your principal there. So
Yeah.
It's all interesting. Anton, do you have a territory, or do you work nationwide, or?
Yeah, we work nationwide. It's mostly in the southern states where we are active in. and the Midwest, right? So California, we do not really that much. We also do in some loans in the Western United States, like Oregon, where you are based, and Washington. But the bulk, certainly, particularly when it comes to multifamily, is really in the Sun Belt and in the Midwest, where most of the activity is really taking place.
Gotcha. You mentioned bridge construction and kind of the, what I'd consider just traditional operating properties. Do you guys do any new construction lending?
Yes, we do new construction. We also do non-multifamily, right? So obviously we talk a lot about multifamily, but we do self-storage, we do office buildings, retail, if it works out, even hospitality, as long as the situation is right. Obviously, if someone is underwater based on where they bought the property and where it is today, it might not be doable without an injection of new equity. But certainly when it comes to acquisitions of hotels, financing is available for the right buyer and for the right price.
Got it. So overall, is there a kind of a rule of thumb you would express to the listeners for today's lending environment, as far as like percent leveraged, or percent down payment, or is it more just kind of deal to deal, and just you're going to have to make sure that you have enough equity to get you the 125 cover ratio, and make sure you have some capital on the sideline in case you need to, for operational or otherwise? Or is there any kind of words of wisdom you have?
Yeah, so I would say on the multifamily side, the availability is really there to get up to 80% leverage, as long as the debt service coverage supporting it. When it comes to other asset classes, I would say it's somewhere in that 60 to 70% range, typically, maybe 75. So it's a very, apart from some retail and hospitality and offices where that still struggle, the market on the lending side is probably as strong as ever. So for the right deal, you're able to get to very high leverage, and in most instances, as we discussed before, it's debt service coverage constrained, and that might reduce your leverage down to a lower level.
Gotcha. Hey, Anton, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's a couple of strategies we look at. We first look to see if we can avoid the risk. If we can't avoid it, then we look to see if we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. I like to ask my guests if they can look at their own situation. Could be their clients, investors, tenants, the market, or however you want to frame the question and the answer. But the question is about, what do you see as the biggest risk? And for clarification, I'm not necessarily looking for an insurance related answer, because risk is everywhere. But if you're willing, I'd like to ask you, Anton Mattli, what is the biggest risk?
Yeah, obviously, as you mentioned, risk is everywhere. A lot of risks can be mitigated, at least, right? And insurance obviously is a perfect tool for that. Some risks cannot be mitigated, and it brings me back to the financing side. And for our own investments, as well as for our clients, I would say the biggest risk is really that when you own a property, that you potentially lose that property, even though it cash flows. And this is, we have seen it in 2008 and 2009. I know we get back to that time period, but doing market disruptions, you will have a situation potentially where you may not get financing as it would be available today. And if you get financing, it might be at terms that your NOI and cash flow cannot support. And this is, in my view, is really the biggest risk, that one is owning a property and one is in a financing situation and is not ready for that black swan event, during which one potentially would have to refinance or sell the property. So my solution and recommendation really is for that is make sure that you have a lower leverage or a longer term of the loan, so that you are not caught of needing to sell the property or refi the property, the loan that is in place doing such a black swan event, which essentially means is that one should always have at least 1 year, ideally 2 years of a remaining term on the loan left, to avoid such a black swan event, right? When we look back to 2008, 2009, if you had to refinance a property right during the worst period of time, it was not available for a lot of the borrowers. However, if one was able to wait it out for another year to 2 years, financing came back and they didn't lose the property. And that is, I would say, is probably my biggest fear from a risk perspective, but also something that can be resolved by just keeping the term of the loan out for long enough so that one gets not caught in the middle of such a black swan event.
No, that's good advice. I've listened to many people that have said what tripped them up during the 08 crisis, and basically it was just kind of over leveraged and being stuck where they had to get out, or like you said, lose property or whatever. And so it's always good to have that kind of perspective, as opposed to a lot of times I think that the lenders are all willing to apply you with money and kind of fatten you up there and give you all sorts of cash. But if you don't have a place to put it, and something that's going to make money, and you can't, and your terms, I mean, that's a bad end to the story if that's the way you got to end there, if you end up losing your property. So that's good.
That's right. But and again, I would say it's really the important message is you may be cash flowing with the current loan that is in place, but that doesn't mean that you can refinance into a similar type of loan doing these black swan events. And that's really the key message there.
No, that's good. Hey, Anton, where can listeners go if they'd like to learn more or connect with you?
Sure. Our website is peakfinancing.com. So we have a lot of information there. Also a link to, we call it the ultimate guide to multifamily financing. So everyone can download it. I can be reached at Anton, A-N-T-O-N, at peakfinancing.com. I'm also pretty active on Facebook and as well as LinkedIn. So I'm sure anyone who wants to reach out to us, they can reach me or one of my colleagues pretty easily.
Got it. Anton, I can't say thanks enough for taking the time to talk today. I've enjoyed it and learned a lot, and I look forward to doing it again soon.
Yeah, same here. Thanks for having me on.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.